Welcome to the Maverick of Investing, a tale on Jack Bogle. Today, we're going to take a look at the life and legacy of Jack Bogle, the man who revolutionized the investment industry with his ideas about low-cost investing. From his childhood in New Jersey to the time he spent at Princeton University, we'll explore how Bogle's early experiences shaped his views on investing, and how he went on to found the Vanguard Group, one of the largest and most respected investment firms in the world. Along the way, we'll also explore the opposition and criticism Bogle faced from many in the industry, and how he persisted to make his dreams mainstream. By the end of this video, you'll have a deeper understanding of the man and his impact he had on the investment world we know today. So sit back, relax, and let's dive into the world of Jack Bogle. Jack Bogle was born in Montclair, New Jersey in 1929. The second of four children, he grew up in a middle-class family, and his father was a successful businessman. Bogle's childhood was marked by a strong work ethic instilled by his parents, who emphasized the importance of education and hard work. However, in the 1930s, his family was impacted by the Great Depression. They lost their money and had to sell their family home. During this time period, his father also fell into alcoholism, which resulted in his parents' divorce. In his high school years, Jack and his twin brother David attended Manasquan High School near the New Jersey shore for a brief time. Their academic record enabled them to transfer to Blair Academy on work scholarships. During his time at Blair Academy, a prestigious prep school in New Jersey, he developed an early interest in the stock market. He would often read the stock tables in the newspaper and would keep track of prices of stocks he was interested in. This interest in the stock market was something that would stay with him throughout his life. After graduating from Blair Academy, Bogle went on to attend Princeton. At Princeton, he majored in economics, and during his time there, he continued to follow the stock market closely. He also worked part-time jobs to help pay for his education, which further instilled in him the importance of hard work and financial responsibility. His early interest in the stock market, combined with his strong work ethic instilled by his parents, would lead him to make a significant impact in the world of investing. After graduating from Princeton in 1951, he began working at Wellington Management Company in Philadelphia. He worked there for several years, eventually rising to become a partner in the firm. During his time at Wellington, Bogle was responsible for managing several mutual funds, including the Wellington Fund. He also served on the board of several other companies and was involved in various aspects of the investment industry. In the 1960s, Bogle began to develop an interest in the concept of index funds. He believed that by investing in an index fund, rather than trying to pick individual stocks, investors could achieve better returns with lower costs. He began to research and write about the topic and became convinced that index funds were the future of investing. The average expense ratio for a mutual fund in the 1960s was relatively high compared to today's standards. According to data from Morningstar, the average expense ratio for an actively managed mutual fund in the 1960s was around 1.25%. This is significantly higher than the average expense ratio for mutual funds today, which is around 0.63% for an actively managed fund, or 0.09% for a passively managed index fund. It's worth mentioning that during the 1960s, Jack Bogle was in the beginning of his career in the mutual fund industry, and he was already noticing the high expense ratios of mutual funds and the impact they had on investors' returns. His idea about low-cost investing, which he later implemented at Vanguard, were a direct response to the high expense ratios of mutual funds during the time. At the age of 38, Jack Bogle became the head manager of the Wellington Fund. During this time, he performed a financial blunder that cost him his job at Wellington. He later stated, "When I became the head of the Wellington Management Fund, I did an extremely unwise merger and got wrapped up in the excitement of the go-go era. As a result of that stupid decision, I got fired." The great thing about that mistake, which was shameful and inexcusable, and a reflection of immaturity and confidence beyond what facts justified, was that I learned a lot. And if I had not been fired, then there would not have been a Vanguard. Out of these ashes, in 1974, Bogle founded the Vanguard Group, With $11 million he raised from a group of investors, including himself, to buy the Wellington Fund. He then transformed the company into Vanguard and started to operate it in a unique structure, which is known as the mutual structure, where the fund shareholders own the company that manages the fund. This structure allowed Vanguard to be the first company that could offer low-cost mutual funds to the public. Jack Bogle faced several struggles in his early days at Vanguard. One of his biggest challenges he faced was convincing investors to trust his idea of low-cost investing. Many investors at the time were focused on trying to beat the stock market by picking individual stocks or paying high fees to fund managers for their expertise. Bogle's idea of simply investing into the broad market and keeping costs low was a novel concept that was met with skepticism. Another major struggle Bogle faced was trying to build a team and infrastructure to support his vision. He had to assemble a group of dedicated individuals who believed in his ideas and were willing to make them work. Additionally, he had to build out the technology and systems needed to track and manage the index funds he wanted to create. In 1976, influenced by the works of Paul Samerson, Bogle created the first index investment trust, a predecessor to the Vanguard 500 index fund. This was the first index mutual fund available to the general public. It was not immediately well received by individuals or the investment industry. Bogle continued to face opposition when he introduced the idea of passive investing, in a world where their traditional wisdom held that only active managed funds could yield good returns. Many professional portfolio managers in the industry claimed that index funds were nothing more than a pipe dream, and critics argued that the only way to achieve success in the stock market was through the knowledge and expertise of professional portfolio managers. But Bogle refused to be discouraged. He knew that the high fees charged by active managers were eating into investors' returns and believed that the low-cost, passive option would be a game changer for the average person. Determined to prove the naysayers wrong, the launch of the Vanguard 500 Index Fund was met with fierce resistance from the established players in the industry, who saw this as a threat to their business. But Bogle's persistence and unwavering belief in his ideas paid off, as the fund quickly gained popularity amongst investors. I would now like to share some of the knowledge from the man himself, including his 10 principles on investing, and then close on why we as investors must always remember his principles.
I was born into a family that had had considerable wealth, but it all vanished, literally went to zero by about 1932 or 1933. So we were on our own, and we had to make do with what we could. We had to begin, as we got a little bit older, had to earn what we, if you wanted something, you went out and earned the money to get it. And we lived with our grandparents for a few years. That was not atypical of those Depression years. And so I tell people I grew up in the most ideal possible way. And so you start working when you're 8 or 9, delivering newspapers and magazines, and then you become a waiter, which was my prime occupation for many, many years, and I loved it. I was a waiter at Blair Academy. We worked our way, we Bogle kids, through Blair Academy, won scholarships and jobs, and only one of us could go to college. There wasn't any resources at all, and I was the one that could get the scholarships and the jobs, which is how I ended up at Princeton University. Well, first of all, it didn't hurt to have gone to Princeton. I was not a great student at Princeton at the early years, and in fact, in my first economics course, I got a 4, which is the equivalent of a D, and if you kept that through the semester, you lost your scholarship. And since I had no great line of people waiting to pay my tuition, that would have been the end of my college education. But I finally got it up to a 3-. This is called progress. You got to start somewhere. And that crisis passed. And the interesting thing about it, that is, it was the book that did me in was Dr. Samuelson's Economics, his original textbook, now in its 19th edition, hurting everybody, I guess, along the way. And so he and I became great friends. He became the first real booster and the inspiration for the index fund. And then I interviewed at Wellington Fund. That was the only major, really, firm of any account at all here in Philadelphia. And my mother was dying. She would die shortly after I graduated. I didn't want to be very far away. And Mr. Morgan, the head of Wellington, took quite a shine to me, the founder. one of the great men of the industry, one of the great pioneers. And he had a lot of confidence in me at a time when I didn't have, and brought me along, and wrote to, when he hired me, wrote to our staff, which was probably 80 people in those days, that I knew more about the industry than they did. And that was, of course, not true, but it was nice to read. I've still got the memo. And so I started there, and we didn't really have any kind of a triangle, sort of an organization chart. But within probably less than 10 years, it became clear I was going to be the heir apparent. And when the company got in trouble, because it was too conservative, Wellington Fund was conservative during the go-go era, and when all the money was going into the wildest kind of mutual funds that you ever heard of, rapid growth, emerging growth, whatever it might be, funds, and we did not have one. So he said, do whatever it takes to fix this company, which happened to be, at that time, publicly held. So I had an obligation to Mr. Morgan to maximize the value of that investment. And I don't want to deflect any blame on anybody but myself. It was my decision to do this merger with a firm that did three things. Brought us in new managers, Wellington Fund was faltering, brought us in a go-go fund called iVest Fund, and brought us into the pension management business. It was a small firm, very small firm. It was often said that the mouse would swallow the elephant at this time. But I had confidence that these four managers, four partners, would be eternally good managers. There is no such thing. Everybody comes and goes. And reversion to the mean. You're above average, you're going to go back to below average, and then finally settle in around average, unless you mess things up, in which case it's much worse. And so the merger was a huge success for 4 or 5 years. And then the market collapsed in 1974, and my opponents banded together and fired me. I couldn't think of anything to use except the S&P 500 index. And the reason that's a great index is it's weighted by the market capitalization of the company. So if the market capitalization of, say, General Motors goes up 5%, the fund's investment in General Motors goes up 5%. So you don't have to do rebalancing. One of the earliest attempts to do indexing, which I'm not even sure was called indexing, was the Samsonite pension plan. And that was run by Wells Fargo. And they chose the New York Stock Exchange Index. This is earlier than 1975, probably about 1972 or 3. And they couldn't make it work. It was a nightmare because it was price weighted. And every time the price changed, they had to change everything around. And and they actually finally got wise and picked the S&P index a few months after we had picked the S&P index for the new fund. It was just a fortuitous choice because I really didn't know anything else. Okay, well, let's look at the investment management business, and for this we'll use as a proxy the mutual fund industry, which is a really good proxy because we've got plenty of data on it. We don't know exactly how others are doing when they're doing it. And that is, if you think about the mutual fund industry, it's charging around 2% a year for its wares. So if you can, and what are they getting as an average return? All these managers together, competing with one another, turn out to be average. What else is new? Everybody thinks they're going to be above average, but in the long run, the average is composed of that same group of managers, and they have to be average. But they're only averaging average before they deduct the cost of investing. A great business, but a bad profession. And great for the business side, bad for the fiduciary side. Great for the money managers, bad for the fund investors. This is not a proposition that I ever warmed up much to once I figured it out. There is this modern thinking that the total world market should be the way you invest. I'm not so sure about that. I'm always a contrarian. I'm always from Missouri. My thought process is two lines of thought. One, we earn our money in dollars. We save our money in dollars. We spend our money in dollars, and we invest in our money in dollars. Why wouldn't you want to stick with dollars as your only medium of investment? You don't have to worry about currency and all that kind of thing. The second level is, if you look at the U.S. corporate world, 50% of its revenues and 50% of its profits, earnings, come from outside the U.S. So you already own an international fund. And then someone says, well, they fluctuate differently, to which I would say, so what? That's not a good reason for doing it at all.
Remember reversion to the mean. Could you expand on that one? That seems to be one of your importance.
Well, that's an eternal rule. It's like the law of gravity. What goes up must go down. And in the financial markets, it really works. I have an example in the book. The point of all this, Jim, is don't buy funds on the basis of past performance because it's not going to continue, or it's only the extraordinary case when it's going to continue. So people tend to, as I mentioned earlier, put their money into these big winners, and then down it goes. They pick the high because that's when the fund looks the best.
Time is your friend, impulse is your enemy. What do you really mean by time is your friend?
Well, we have the miracle of compound interest working for us. And when you invest over 20 years, 30 years, 40 years, 50 years, for today's young people, an investment lifetime is probably 70 years. Their life expectancy today is, if you're 20, is probably 90. So you're going to be, and then you're going to be investing, after you retire, of course, and presumably that's in your 60s or 70s for some people. And
not you, but
not me. But that curve is just a sweeping curve, and it's the miracle of compounding returns, and it pays off hugely. Albert Einstein called compound interest the greatest financial miracle of all time, or something like that.
Third simple rule for investment success, buy right and hold tight.
Buy right means diversify, diversify, diversify. In an index fund, which is a great way to invest for reasons I've talked about earlier, you at low cost and all that, but you're diversified, so the intricate ins and outs of the market, steel stocks are doing better, or energy stocks are doing better, or healthcare is doing better, or technology is doing better. If you own the whole market, you get your share of all of that.
Another one of your 10 simple rules are to have realistic expectations. And then you talk about the bagel and the donuts and distinguish the two.
Okay. Well, the bagel and the donut is a talk I gave years ago, and I contrasted, like the investment world. The bagel is nutritious, good for you, substantive, while the donut has a certain sweetness, and it kind of breaks up and crumbles when you eat it. And so long-term investing, holding on, the strategy I just described, is the bagel, and short-term speculation is the donut.
Your fifth simple rule is forget the needle, buy the haystack. What do you really mean by that one?
Well, that's the ultimate argument for indexing. Picking stocks or funds, finding that elusive needle that will give you what you think you want in the future, is very difficult. We all know the metaphor of finding a needle in a haystack. It means forget it, it's not worth trying. And I would argue the same thing here. Own the haystack means own the entire U.S. stock market, or the entire world stock market. Everybody has different ideas about that. And don't do anything once you get the haystack. No more looking for needles.
And another one of your simple rules is to minimize the croupier's take.
Okay, that's a very good parallel to something I mentioned earlier, and that means get costs out of the equation. I mentioned to you the magic of compounding returns over the long term, the mathematical magic of it. The problem we have in our society is that magic, on the record, is overwhelmed by the tyranny of compounding long-term costs.
There is no escaping risk. And this is probably a particular problem for people who are older, retired, no longer bringing money in through their work and their labor, have X dollars of a portfolio, maybe Social Security, maybe pension. They don't want to incur risk, but you're saying there is no escaping risk.
Well, the basic argument there is that inflation, which you have no control over, eats away at the value of your dollars. You may think you're being safe if you buy a bank CD or an equivalent instrument and let's say over 10 years. But that the instrument's going to lose 30% of its value conservatively over the next 10 years. They'll have a little bit of interest to offset that. But if the dollar is worth 30%, which is roughly 2.5% per year in inflation, that's gone. You've taken a big risk by, in effect, speculating, for the want of a better word, that the dollar will remain unchanged, and it never has, and I don't think in our lifetimes it ever will. Maybe sometime, but so there's the big risk. So when you look at, say, stocks and bonds, stocks at least have a fighting chance to overcome the ravages of inflation. And the way I look at it, I've got some math behind this, because with a dividend yield of stocks about 2%, and potential earnings growth should be in the range of 5%, stocks should give you about 7% over the next 10 years, gross, before cost, before anything. So that's a fairly conservative number, but I think it's realistic. And bonds should probably give you about 2.5%. So if you think about inflation, if there's 2.5% inflation, and the bond gives you 2.5%, you're doing a break-even investment over the next 10 years.
You talk about beware of fighting the last war. What do you mean by that, the last war?
Well, when we tend to look back, we tend to look at the kind of returns, the kind of economic environment we've had. And right now, I mean, I actually wrote quite a bit of this in depth back in the, say mid-60s, and everybody was paralyzed with fear about inflation. We had inflation running at 5 or 6 or 7%. They say, how can I avoid inflation and do this or that or the other thing? And at that point, the inflation stopped. And we had, I don't know the exact number, but probably after that high inflation, we probably had an inflation rate of 2 to 3% is all, maybe 4. So if you're fighting against previous inflation, you're making a tacit assumption that will continue in the future. It doesn't, or usually doesn't, or often doesn't, but we never know when that change is coming. It's kind of complicated.
Another one of your simple rules is the hedgehog beats the fox.
Well, I use that to portray the difference between passive index investing and actively managed fund investing. The hedgehog, the saying from Archilochus, Greek philosopher who just left a few fragments of his work, was the fox knows many things, but the hedgehog knows one great thing. And what the hedgehog knows is that all this fooling around out there does you no good at all. Own the market. It's another way of saying that. And the fox, oh my, are they smart. They're smarter than all the hedgehogs put together. Get down to Wall Street and talk to all that immensely wealthy brain power that, of course, builds nothing because they're competing with other brain power. I'm not saying brain power is wasted. I'm saying the average brainiac is average compared to the other brainiacs. So they can't win. We know that.
The last simple rule is stay the course.
Well, we've kind of talked a little bit about that behind the scenes here, and that is once you've set an intelligent asset allocation, taking into account your risk preferences, taking into account your whole financial program. A lot of people, for example, ignore the value of Social Security as a capitalized value for a typical person at the time of their retirement of $400,000 or $500,000. That's your asset. It produces an income stream. You don't have the asset, but you have the income stream with a cost of living hedge. Don't leave Social Security out of your equation when you look at all that. But just get it all right, and then don't touch it.
There's one more person I would like to introduce to you today, and I'm quite sure he's here. I haven't seen him, but I understood he was coming. There's I believe that he's made it today, and that is Jack Bogle, who I talked about in the annual report. Jack Bogle has probably done more for the American investor than any man in the country. Jack, could you stand up? There he is. Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. I mean, Paul Samuelson talked about it, Ben Graham even talked about it, but The truth is it was not in the interest of the investment industry of Wall Street. It was not in their interest actually to have the development of an index fund, the index fund, because it brought down fees dramatically. And as we've talked about some in the reports and other people have commented, index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole. And part of the reason for that is that they brought down the costs very significantly. So when Jack started, very few people, certainly Wall Street, did not applaud him, and he was the subject of some derision and a lot of attacks. And now we're talking trillions when we get into index funds, and we're talking a few basis points when we talk about investment fees in the case of index funds, but still hundreds of basis points when we talk about fees elsewhere. And I estimate that Jack, at a minimum, has left in the pockets of investors without hurting them overall in terms of performance at all, gross performance. He's put tens and tens and tens of billions into their pockets, and those numbers are going to be hundreds and hundreds of billions over time. So it's Jack's 88th birthday on Monday. So I just say happy birthday, Jack, and thank you on behalf of American investors.
Jack Bogle's advice is a lifesaver for anyone who's just getting started in the stock market. Investing can seem like a daunting and complicated world, especially with so many opportunities for the average retail investor to be taken advantage of. But with Jack Bogle's proven investment principles, you can feel confident in your financial future. By following Bogle's approach, you'll have a roadmap to success and peace of mind, knowing that you're making smart investment choices. So whether you're just starting out or a seasoned investor, taking Bogle's advice to heart can lead to a brighter financial future for you and your loved ones. If you enjoyed this video, make sure to give it a like and subscribe for future videos.